Good morning, Vijay ji.
Good morning, Naveen ji. Good morning.
Good morning.
Good morning, everyone. This is Ashwin.
Good morning, Ashwin ji.
Good morning.
Still, good morning, Harsh ji. Ashwin ji, still there is a issue in your camera?
Yes, sir. The problem is my laptop, the webcam is not working.
Okay, you can connect with the two devices.
Oh, okay.
Even you can connect one from laptop and additional one from mobile. Both are allowed.
Oh, okay. I'll do that. Since
So,
you told that laptop is
so
not...
at least other participants may see your face.
Yeah. I'll do that. Just give me a few minutes.
Good morning, Mr.
Rohit ji. सर लगता है आपका स्पीकर काम नहीं कर रहा।
विजय जी एक रिक्वेस्ट है।
बताएं ना सर।
ये जो फ्राइडे से लेके आज तक जितना भी सेशंस हुआ है उसका अगर आप पीपीटी कल तक शेयर कर सकते हैं तो बढ़िया रहेगा क्योंकि
100% शेयर हो जाएगा। इवन वीडियोस विल बी शेयर्ड।
ओके
मतलब मींस फ्राइडे सैटरडे का तो आज ही शेयर हो जाएगा, संडे का या तो लेट नाइट और मे बी टुमारो मॉर्निंग।
जी सर, ताकि नेक्स्ट सेशन जो फ्राइडे रहेगा उससे पहले थोड़ा प्रिपेयर कर सकते हैं जितना।
सुमित जी की प्रेजेंटेशन आ चुकी है।
ओके,
गुड मॉर्निंग प्रीति जी।
Morning, sir. Sorry for the delay. Some internet problems.
No, it's okay. In this new normal, there will be some issue definitely. You are in office in the morning?
Just my office room.
Okay.
Sunday morning.
We have just planned after the lockdown that at least one office room must be there in the home.
Yeah. There's no other way.
Bablu?
नमस्कार सुरेंद्र जी।
नमस्ते सर।
डेली टाई पहन के बोर हो गया था तो आज सोचा कि आज टी शर्ट पहन के बैठते हैं सेशन में। अदरवाइज तो संडे को भी व्हाइट शर्ट एंड टाई।
संडे अलाउड है
सर। एक्चुअली क्या है, आई एम हैंडलिंग 3 पोजीशंस। सीपी कमेटी चेयरमैन इन एनआईआरसी ऑफ आईसीआई, तो उसके अंदर सेमिनार कमेटी का चेयरमैन ही मैं हूं, तो एक डेकोरम मेंटेन करने के लिए। एंड अनदर चैम्बर ऑफ चार्टर्ड प्रोफेशनल, आई एम द प्रेसिडेंट ऑफ द चैम्बर ऑफ चार्टर्ड प्रोफेशनल्स। अराउंड 100 webinars we have conducted since 22nd March, and on daily basis chartered accountants students session as well as member session. So 10 से 15 मिनट तो लगाने ही पड़ते हैं उसमें, और जब कोई सेंट्रल काउंसिल मेंबर आता है तो फिर हमें पूरा टाइम रुकना पड़ता है। को चेन्नई से मिस्टर दयानिवास शर्मा जी इज टेकिंग सेशन ऑन पीयर रिव्यू। बात करके पता लगा ही वाज आल्सो राजस्थानी, सेटल्ड इन चेन्नई। निखार जी लैपटॉप इस्तेमाल कीजिए, डेस्कटॉप इस्तेमाल कीजिए, मोबाइल्स के क्लासेस अटेंड करने में अनकंफर्टेबल रहेगा।
लैपटॉप चालू करता हूँ मैं, तुरंत कर लेता हूँ लैपटॉप चालू।
हमें तो एक साथ 3 सेशन अटेंड करने होते हैं, तो एक मोबाइल पे, एक लैपटॉप पे और एक डेस्कटॉप पे चला रहे होते हैं मजबूरी में।
कर लेता हूँ लैपटॉप तो भी लगा लेता हूँ 10 मिनट।
Abhi only 6 participants have joined. And try to on your video always. Specific किसी समय 2 मिनट के लिए 5 मिनट के लिए बंद किया, then it is okay. Otherwise gathering feel नहीं होती है. Faculty feels like he is sitting alone and talking to all. सुरेंद्र जी, लाइट आप अपने फेस पे लेके आइए. आपके पीछे विंडो है तो विंडो की लाइट से आपके फेस पे अंधेरा आ रहा है.
जी जी सर.
हाँ, वेबिनार के अंदर सिस्टम हमें उल्टा करना पड़ता है. लाइट फेस के ऊपर होनी चाहिए, फेस के पीछे नहीं. अब बिल्कुल अब ठीक लग रहा है. अश्विन जी, आपने लिखा इट्स नॉट ऑडिबल फॉर मी, तो आई थिंक आपके किसी सिस्टम में इशू है. यू हैव टू चेक योर स्पीकर.
Now it is audible, sir. Initially when I joined, it wasn't audible.
Okay. 1 2 3 4 5 6 7. Naveen ji, we should wait for another 4 to 5 minutes.
Okay.
Khandelwal.
बस काम करने के लिए ही जाता हूँ. Our today's session is on the specific evaluations. Valuation on the specific field. So some practical, some theoretical. In the mid session, it will be completely theoretical. And at the end, Ind AS. Naveen ji, you may start anytime.
Okay. Right. Thank you, Vijay ji, and good morning, everyone. Again, another Sunday of lockdown, and probably now we are all getting accustomed, not getting accustomed, I think we are all accustomed to this situation of lockdown. And as Vijay ji said, this is the new normal. And I think we are all utilizing our time in the best possible manner. And when we have joined this course again, let me tell you, friends, after these 7 to 8 days of training, you will yourself feel more confident, more related, more knowledgeable, because the evaluation course will give you an insight not only on the valuation aspect, but on different laws which you have forgotten at times, and also to new laws. and probably it will develop a new horizon, new thought process for all of us. So yesterday we had covered a particular topic where I discussed the valuation approaches, and today I'll take it further, applying those valuation approaches to specific situation. As Vijayji said, that we will be doing some theoretical as well as practical concept. So I'll be covering the topic of valuation under specific situation along with the practical aspect. Some questions on the chat box. I think regarding the presentation part, nothing to worry. Everything will be done in due course of time. Yes, okay. Vijayji ne bola, sorry. So everything will be done in due course of time. We will get all the presentation, all the content material. And today I'll be discussing some of the exam tips also, exam strategies also, and how to study for exams. That is also very important. So during the course of the lecture, we'll be sharing those thought process. So friends, let me start with the topic on the valuation under specific situation, which tells us that we have to cover valuation under stress assets, valuation of startup entities, valuation of small and medium enterprises, and valuation of cyclical firms. These are all specific situations which an enterprise would undergo during the journey of its life cycle. And probably everybody will start with the concept of startup, then they'll turn into a small and medium enterprise. Then they may be subject to a lot of cyclical issues, and maybe at some point of time, because of certain issues, they may fall into stress. So at each point of time, the valuation may be different, the criteria may be different. So, but the approaches would remain same as discussed yesterday. So let me just recall the concepts of yesterday, friends, so that we are on the same page, and everybody should be tuned into the valuation channel. You're listening to the valuation channel organized by Vijayji's effort. I hope we are on the same page, and maybe you can term me as the faculty, your friend, or the supporter, or the RJ for today's lecture, right? Okay, so let me start with a few practical aspects. I hope everybody will be able to answer it. This is the question, friends.
Sometimes please use your audio as well, so that it can be interactive instead of always reply by chat. Sometimes use at least.
Yes, sir. As Vijayji has mentioned that as a participant, if you want to be the session to be interactive, you can use all the modes. You can use a chat box. You can use your unmute yourself and ask questions, so that the class remains as interactive as possible. Because what I have experienced that over a period of time, when you discuss, I think a lot of doubts get cleared, and it will help you in your exam part. So can we have the answer to this question, friends? So if you are able to recall the formula, yesterday we had discussed the formula for CAPM formula for calculation of KE, CAPM formula for calculation of KE, and if you are able to recall that formula of CAPM, where the formula is has different components of RF, RM minus RF, and beta. I hope you are able to recall that formula. So I'm just trying to recall that formula by solving one question, because all these concepts are going to be used today and in your next few lectures also. Yes, friends. So can we have the answer from your end? Just trying to activate our mind, getting accustomed to the world of valuation.
18%.
As mentioned, the answer is 4. Okay. Can we have it from others also?
18%.
Nikhar is mentioning it is 18%. So especially they have asked what is RM, that is return on market. So if you are able to just refresh the formula, if that is written by you on some page, then you can use that formula, or I'm repeating the formula again. K is equal to RF plus RM minus RF into beta. So no more answers. So let me solve it. Anybody else who would like to answer? Otherwise, I'll solve it. So K is equal to RF plus RM minus RF into beta. Yes, do we all agree with this formula? So Rohit sir has mentioned that 18%. So KE is given as 15. Friends, KE is given. We don't need to calculate KE. Remember, the required return is given as KE. 15% we have to calculate RM. So RF is given as 9% plus RM we need to calculate. That is the missing figure. RF is again 9 and beta is given in the question as 1.1. So can we solve this equation for RM, friends? Can we solve this equation for RM? And I believe that definitely the RM should be less than 15. RM should be less than 15. Why? See, again, from the data also, you can interpret that whether RM should be more than 15 or less than 15. Yesterday, we had discussed this concept that stocks having beta more than 1 will give more return than the market. So here in the question, the stock has a beta of 1.1. Therefore, the 15% return on the stock is obviously more than the market. So therefore, the RM, that is the return on the market, should be less than 15. So it cannot be 18%. Based on the concept of beta also. And if you solve this equation, the answer would be coming to as, yes, anybody who would like to make it a try, give it a try. Archie is 19.5 RM. No. Can we solve this equation? I think everybody can do it. Sorry, beta is 1.5, not 1.1. So I think if you solve this equation, the answer would come to as RM.
Answer is 13.
13%. Yes, RM is 13%. Correct. RM is 13%. So just applying the mathematical equation concept and solving it for RM. Any doubts you can definitely ask. Okay, so I'll give another question so that the concepts are again more clear. Another question for all of you friends.
निखार जी आपके यहाँ से आवाज आ रही, मैं आपको म्यूट कर रहा हूँ प्लीज.
Yes, can we solve it, this question, friends? Yeah, beta is 1.5, Mr. Harsh, correct. So in this question, we have to calculate beta. We have the RF is given as 8%, the RM is given as 12%, the KE is given as 15%, and we have to calculate the missing figure of beta. We'll request everyone to give it a try. As I said, activation of mind is very much required because mind needs some time to get into the framework. It's not a machine that you just push on the start button and it will start, because we have a biological process with our body. So it takes time to get all the hormones activated. So basically in physical terms, what we are trying to do is stretching our mind. As we go for exercises in gym, we first do the stretching part. And that is what we are trying to do, stretching our mind so that mind gets conditioned. Anybody with an answer? We have the first answer, Mr. Harsh, Mr. Nikhar, 1.75. They are mentioning beta as 1.75. Lokesh is also mentioning 1.75. Okay, great. So again, going by the equation, friends, by the relationship, the 15% is equal to RF is given as 8 plus RM is given as 12 minus 8 into beta is the missing factor, friends. Beta is the missing factor, so the correct answer would be 1.75. Beta is the missing factor, so the correct answer is 1.75. I hope now it is clear. Okay, because I'm getting very few responses. Let me give another try. Okay, let me see how many of you can try this. Yes, so can we have the answer for this question? Same equation, but only the calculation, the figure, the unknown figure is changing. So we have the risk-free return, the required return, 15% beta is given. Sorry, yeah, we have done this question. Oh, sorry. It's the same question. Just a second, please. This is not the question. Just a second. A very simple question. I think everybody should get it. Yeah. Everybody should get it. So where the RF is given, the RM is given, the beta is given, you just need to calculate K. Straight away applying the formula. 16.5, Mr. Harsh is mentioning 16.5, which is the correct answer. Nikhar, 14 nahi hoga. There is some calculation mistake. Yes, Lokesh, correct. 16.5 is the correct answer. Right, so we just need to apply the formula, friends, and we get the answer. The formula is what? It's nothing but 12 plus RM is 15 minus 12 into 1.5. That's it. Nothing else. Very simple. Applying KE. Okay. Let's give it a try for this question. Okay. Anybody could. Can you read this question or take a snapshot also, so that the question will come in the next slide, but you have the data. Please read the question carefully. The question says that the up-to-date financial statements are given. The FCFE per share, that means the free cash flow per share, remember, it is per share, not the total amount. And the expected free cash flow growth rate in FCFE is given. Then the company's beta is mentioned as then current risk-free rate is given, equity risk premium is given, other financial information is given, outstanding number of shares, tax rate is given, interest expense is given. Okay. So can you take a snapshot, friends? A screenshot of this particular slide, and I'll move on to the question. It's a question which has been asked in exam. Not once, not twice, maybe multiple number of times. An exam case study question of 8 marks. Exam case study question of 8 marks, friends. Now, obviously, whatever we have studied so far, we have to apply those concepts. And yesterday we have been able to recall, yesterday we had discussed the valuation approaches. So I'll just focus on very basic question, not going into very technical details. I hope everybody's taken a snapshot, screenshot. So the question is, COE is closest to, COE is nothing but cost of equity. COE is closest to cost of equity. Cost of equity means applying the CAPM formula. Cost of equity applying the CAPM formula. Again, going back to the question, friends. Now, based on this, can you calculate the cost of equity for me? Cost of equity. So RF is given. Equity risk premium is given. Beta is given. So can we have the answer? Can we have the answer? RF is given, equity risk premium is given. Why Harsh 6.3? RF is given, equity risk premium is given, and beta is given. Why 6.3? Very straight away answer. It's a 2-mark question for exam. Everybody should get it correct. We have to calculate KE, friends, cost of equity. 6.2, Lokesh, how? RF is given, equity risk premium is given. Okay, so let me solve it. So nothing, RF is given, that is 3%, equity risk premium is 3% plus equity risk premium 5 into 1.6. That is equal to how much? 11%. As simple as that. No complications, directly applying it, formula. And if you see, the COE is closest to, so 10.01, 7.06, 0.06, and 11.06. So the correct answer is D, 11.06. Correct answer is D, 11.06. Any doubts, please ask. How have you been calculating this 6.2? I don't know. It's a very straight away question. 3 plus 5 into 1.6. Okay. No doubts. Let me move on to the second part. Second part. The terminal value in 6 years closest to. Terminal value in 6 years closest to. So terminal value is closest to. So terminal value. Now we have seen the formula of terminal value. We need to apply the formula of terminal value, and terminal value is always based on last year cash flow growth, last year cash flow for the growth period. So I would request everyone, to calculate the possible free cash flow per share at the end of 6th year. So how do we calculate? So let us start the calculation. Current FCFE is 1 rupees. Current FCFE is 1 rupees. So apply 8% growth for 1 to 3 years. Current FCFE is, so 1 into 1.08. That is 1.08. Then 1.08 into 1.08. Then 1.08 into 1.08 into 1.08. This was the 3rd year. Any doubts here? Because the question mentions that the 8% growth rate for 1 to 3 years. Thereafter, the growth rate is 7% in year 4. 6.5 in year 5 and 6% in year 6. So what I will do, I'll directly 1.08 into 1.08 into 1.08 into 1.07 into 1.06, 5 into 1.06. Can somebody do the calculation for me? Pardon? Can somebody do the calculation for me? Anybody?
1.52.16.
How much?
1.52.
1.52.
Yes.
So what is this 1.52, friends? This is FCFE per share at the end of 6th year. Do we all agree? We have applied the growth rate to the current figure of 1 rupees for next 6 years, and we get this 1.52 is FCFE per share. Now, terminal value formula says that we start with 1.52 into applying the growth rate for the next 7th year. The 7th year growth rate is around 4% as given in the question. Stage 3, you can see the stage 3. So it is 7%, 4% in stage 3, 4%. Divided by K minus G. K is 11% minus G is 4%. Can anybody give me the figure here? Terminal value.
22.58.
22.58, friends. 22.58. Yes, Nikhar is also mentioning, Rohit is also mentioning 22.58. $22.58. So if you see the question, terminal value in year 6 is closest to. Terminal value in year 6 is closest to. The 4 choices are given in the question: 22.57, 20.42, 24.30, and 25.70. Therefore, the correct answer is option A, 22.57. 22.57. This is the solution, and this is the answer. So friends, we just did 3-4 questions based on yesterday's concept of valuation approaches. Now, why was it required? Again, as I mentioned, that probably the same concept could be used in today's discussion. But again, to give you an idea, friend, that the valuation exam would not be an easy exam. It would not be an easy exam. There will be a lot of issues in passing the exams, and you need to prepare. You need to prepare for the exams, friends. And people, I've seen participants failing at 59.75 and not able to get that 60% marks. So the crux is the underlying morning thought processes, friends. Let's take this course seriously, the whole 50 hours training course. And then if you're serious about getting through the valuation exams, you need to prepare. You need to give some time.
I have a question in this question.
Sure, please ask.
In this question that we discussed, we said FCFA per share is 100, and in the bottom there is outstanding shares 100 lakhs and tax rate for. FCFA, should we take post-tax?
I missed out your last statement, sir.
Sir, the FCFE
Yeah.
per share is 1 rupee.
Yeah.
Okay. So outstanding shares in the last row is 100 lakhs, where the tax
Correct.
rate is given 40%.
Correct.
Now FCFE is for equity. So the rate of return, shouldn't that be taken up for the tax rate of 40%?
So FCFE is after tax. If it was FCF, yeah, it is after tax. So that means the tax impact has already been given.
Okay, so this is a red herring.
This is a, yeah.
Okay.
Correct.
I got
Correct.
caught in that. Okay.
Yeah, right. Okay, friends, now coming back to the concept of valuation in the specific situation. So friends, exam strategy has to be developed, and exam strategy, the first exam strategy would be to solve as many multiple choice questions as possible. Solve as many multiple choice questions as possible. So you need to explore the world of Google, internet to get those practical questions. You search topic wise and you will get a lot of practical questions, multiple choice on the net available, and keep on solving. And I'm sure that if you practice maybe around 1,000 questions or so, you will definitely get through the exams along with the case study situation. Okay. Friends, let me start with the first topic, distressed asset valuation. Now, why the company goes under distress? I think, though we all know that the reasons of a company going under distress is many. So let me focus on the few factors which contributes to the stress of a particular company, not of an individual. Individual stress reasons are a lot of, I think, other reasons. But for a company, it could be operational. Operational in terms of, let's say, the company is not able to produce the right kind of goods. The quality of the goods are not good, or the demand is not there, or a lot of competition is there. So these are all operational reasons, and that is why the company is under stress. Then there could be some possible financial issues, and we have seen that in most of the cases it is the financial part, where the company is either not able to repay the loan, it is over leveraged, cash flow management is not proper, and that is why the company is under stress. Then there could be certain legal and regulatory problems where the company is not able to comply with various laws prevailing in the country, and that is leading to the stress for the company. And the last could be other factors, which could be any other reason, maybe labor strike, people not working, HR issues, which is leading to the downfall of the company, friends. So friends, the reasons for company going under stress are many, and though in exam perspective, not much of relevancy, but then again, trying to create a background that why companies go under stress. And when the companies go under stress, then a lot of issues come up. The issues could be the quality issues on the product part, then customers will go away, over leveraging, we try to take debt to run the company, to repay the debt, loss of key personnel, people leave the company, attrition rate is high, management becomes indecisive because they're not able to take decisions. A lot of litigations pile up, macroeconomic pressures keep on coming, and inventory keeps on piling up. We are not able to sell the inventory part. So the consequence of companies under stress is multifold, and it affects all parts of the business, and therefore it gets into the loop. So what is required to be done at the valuation front? Is there any other formula for calculation of value of a stressed company? First, why do we need a valuation of a stressed company? There are reasons, multiple reasons why. Let's say because we are trying to sell that stressed company, we need to value the company. That is the prime reason, because the promoters or the lenders might try to, yes, to liquidate also, right? Yes. So there are multiple reasons why the valuation would be required. So do we have another formula? The answer is no, we don't have any other formula or technique for valuation of stress asset. That means the approaches would be same, the MIC approach, the market, the income of the cost approach. So there's no change in the approach part. The only thing which can change, that is what we need to understand, is the whole calculation under income approach. We have seen the formula for the income approach that it includes EBIT, increase in capex, working capital, then we have to calculate the present value, the growth period, terminal value, cost of capital, the growth rate. So these are the components of the DCF method. So maybe when we value the stress company, the KO might be different in comparison to the KO of a normal company. The capex may not be there. Then the terminal value will be difficult to estimate. So there could be, possible some changes in the basic formula. The formula will not change. Only the calculation part of each of the component may change. So what are the issues in the stress asset valuation, friends? But first, some important characteristics of a declining company, friends. Declining company means, again, a company under stress. Remember, from exam perspective, a declining company is the same as a company under stress. Okay. So the first point is simple, declining revenues. Second point is simple, negative margin. Third is an exam question. Which means asset divestiture means sale of asset. And that is one of the features of a stress company. Normally, for a going concern, we will always assume that the company would be expanding. So instead of selling an asset, the company would be investing an asset. But here, the feature is just the opposite. So instead of investment in assets, there is possible sale of asset, friends. So that is one feature of a declining company under stress, is that there will be asset divestiture, that is nothing but sale of asset. Then the fourth and the fifth feature is a big payout dividend and stock buyback. So a question should come into your mind that a company under stress paying out big dividends, is it possible? The answer is yes, it is possible. How? As we all know that the buybacks and dividends are made out of reserves, and the company might be having good reserve. Maybe the current situation is bad, but the past record says the company had a good profitability. Now, why would they go for buyback or payout, high dividend payout? Just to ensure the minimum stock price is maintained in the market. Because when you announce a big dividend and stock buyback, there is some stability in the price. So to ensure the stability in the price in the market, there might be possible of buybacks or hefty dividend payout. So that is again one of the features of a declining company. And obviously the financial leverage, which simply means the ability to take more debt, that is on the downside because there is no such possibility of raising funds from the market, friends. So that is always on the downside. Yes, Rohit, Rohitji, yes, sir. I think that is also one of the reasons, because out of the reserves, what should we do with the reserves part? So if they don't have any options of using the reserves for any particular investment, the only option left would be to give out as a return to the shareholders in the form of dividend or buyback. So that is also one possible reason. So friends, what are the issues in valuation, especially in the DCF approach? The issues would be, as I mentioned, that we take a cue or a clue from the formula. The first effect would be that there will be sale of existing asset. We all have discussed yesterday, remember friends, I discussed this specially, that my future cash flows will be coming out of the existing asset which the company has, and it will be coming out of the growth asset where the company would be investing. So in a stress company, there will be no earnings coming out of the existing asset, or might be the earnings will be less because we'll be selling that existing asset. Why? Maybe the reason could be that the existing asset are earning less than the cost of capital. That is why it makes sense to sell the asset rather than to remain invested in the asset. So the asset divestiture effect will come into the picture. Further, there will be no investment in the growth asset. So we don't expect the cash flows to grow because there will be no investment in the capex part. Third, the discount rate will always be different vis-a-vis the normal company's discount rate. Reason again, we all know the reason could be, first reason that because the company has gone for a buyback and dividend payout, therefore the KE would change, the cost of equity may change. Then the market value of debt will not be equal to the book value of debt. Giving a simple example, if the company has an outstanding loan of 50 crores, and if the company is under stress, do you expect that the company will be paying that 50 crores? Any possibility of company paying 50 crores? The answer is no, right? So that means the value of 50 crore will not be equal to 50 crores, friends. The value of 50 crore will be less than 50 crores. And if the company has certain debt instruments, and if they are listed, probably the value of those debt instruments will be less in comparison to other companies, because they'll be treated as a junk bonds, friends. So friends, remember, in terms of debt, we will never take the book value. That is for sure. We'll always take the market value. And for a company under stress, the market value of debt is always less than the book value. It is always less than the book value. So therefore, the cost of capital will be changing. Then there might be a situation where the debt is converted into equity by lenders, because we see in a lot of scenarios where the option is there for the lender to convert the debt portion into equity, and they become the owners of the company. They might take a stake in the company. So therefore, that is again one of the possibilities. And that will change the overall capital structure of the company. That will again lead to a different cost of capital. So when we calculate the value of the firm using the DCF approach, a lot of factors will change. Then terminal value estimation becomes difficult. Why it becomes difficult? Because as we have studied yesterday, terminal value is calculated after 5 years, 6 years, and we have to make an estimation whether the company will be able to survive after 6 years or not. And even if they are able to survive, whether the growth rate will be positive or negative. That is always to be asked. So again, estimating terminal value is a tough job for a company under stress. So these are the factors which will affect the valuation of a stressed company. The formula remains same, DCF, but only thing is the calculation way, the technique, or the components of the calculation might be something different. So let us take one again practical question, and we'll solve that practical question, and we'll understand that how the KO might change for the valuation of a stressed company. Okay, the question on the screen. Request everyone to read the question on the screen. Which says that Anti-Corona Limited has a number of shares traded at a particular price. Then it has got certain book value of debt with a market value, settlement value of 1.5. Company has paid interest. And the bonds of the company are rated BBB because the company is under stress. The 30-year-old government bond is traded at 6.25. And the bonds of such nature of BBB rating rate 0.2 basis point above your normal government bond. RM minus RF is given. We need to calculate cost of capital. If the cost of equity is 4% more than the CF in equity, because the cost of equity will be at premium because the company is under stress. So what we need to do is calculate cost of capital, friends. We need to calculate cost of capital. Cost of capital. So let us do this calculation on Excel. We request everyone to open up the Excel part so that we are clear on how to use Excel. How to use Excel. Though, remember from exam perspective, friends, is Excel allowed? The answer is yes. Answer is yes. There'll be a lot of discussion going on that whether we should take a calculator or not. Normal calculator is allowed. Scientific is not allowed. Excel, if it is there in the system, can be used. But in a lot of NISM centers, you may not find Excel. You may not find Excel. And you may find open office operating system, open office software, not operating system, sorry, open office software, similar to Microsoft, similar to Office 2000, whatever the latest version is there. So you will find Excel, but in a different format or maybe different presentation, but the functions, the operations remain same, remember. So it will be an open office software, and within open office, you'll have the Excel feature. So my suggestion, friends, is that before going to exam, first get a confirmation from the center, visit that center, talk to the center in charge, and understand whether there is Excel or whether there is open office. If there is open office, I would request, please practice for one day on how to use the open office Excel features. Though it is same, but maybe because on the screen it may look different. That is why it is suggestible to at least brush up or just have a flirt with the open office software, friends. Okay. So let me solve it on Excel here, and I hope everybody has noted the contents of the question, taken the screenshot, and very simple approach of calculation of KE. Okay, so anybody give me the formula for Q? Formula for Q. Harsh is mentioning KE plus KD. No, Harsh, I think. Basic formula. And yes, Amit, perfect. And let me write down the weights, W1 and W2 is the market value weights of equity and market value weights of correct, and market value weights of debt, because here there's no preference shares, so I'm ignoring that. Because there's no preference shares, so I'm ignoring that. So let me calculate W1, W2, equity, can anybody calculate the market value of equity for me? Number of shares multiplied by market price. Number of shares multiplied by market price. What is the number of shares? 1.918, yes. Yeah. So 1.13 into, what is the price? 32? And market value of debt 1.5. Weights. Weights apply कर देते हैं. Let's apply the weights. So we have the weights here. Tax rate 35%. Then we'll calculate KE. Again, what is RF? Given in the question as 6.25. 6.25 plus RM minus RF given in the question 5.5. Beta is 1.1. 12.3. Premium 4%. So total is 16%, 16.3%. Right? KD, any doubts? Please ask. KD is given in the question as I said, always take the market rate. Always take the market rate. Yesterday I had mentioned this point. Always take the market rate. Now, if you read the question, the market rate is given as the bonds of such nature are traded 0.2 basis point above the risk-free rate. 0.2 basis point above the risk-free rate. Therefore, $6.45 is the KD. I'll do the basic calculation. 6.25, 0.2. So this plus this, 6.45%. Right? So now we need to just apply the formula for Q, which is nothing but weights into cost of equity plus weights into this into 1 minus 35% into 100. Sorry. 15.81. 15.81 is the final answer. Cost of capital for this company would be 15.81. Any questions you have in the calculation part? Any doubts? No? Okay, so shall I move ahead?
Sir, I have a query.
Yeah, please.
It says RM minus RF is 5.5. Isn't that risk premium?
Yeah, RM minus RF is given. That is the risk premium, correct?
So why have you added 4 cost of
Because
equity?
it is given in the question that for a company under stress, we have an additional premium of 4%. It is given in the question that for the company under stress, therefore the cost of equity will be higher, 4% higher than the CAPM equity. Am I clear? Am I clear? Any doubts? Okay, should I move ahead now? Okay. So let me go back to the presentation. Okay, so we had covered the first part of the stress asset, friends. And we'll be covering the second part of the stress asset now. So the question comes in, why can we do the relative valuation of a stress asset? The answer is no. Why? Because finding out a comparable firm is always difficult in case of stress asset. That too with the similar variable factor which is contributing to the stress, again quite tough. Because you will find that there are very less probability of finding out companies within the same industry going under stress. Though in a current scenario, you can do that because you will find a lot of companies under the stress. But in a normal market scenario, I think it is difficult. That is why adopting a relative valuation, no, right? Very important, friends, this topic, valuation of stress asset under IBC. Very relevant. And let me tell you, friends, practically also, when you enter the world of valuation, I'm sure that you will be getting assignments on this particular topic of valuation under IBC. Because as of today, I believe that everybody is aware that under which law valuation is compulsory from a registered valuer. Under which law?
Companies Act.
Companies Act. And is that all?
Income Tax Act, but Income Tax Act no.
Yes, no, valuation is required under income tax also. But what my question is very specific. Under which law valuation is required compulsorily from registered valuer? So as of today, friends, there are three acts. One is the Companies Act, as per section 247, which tells us that any valuation under Companies Act would be done by a registered valuer. That is a compulsion. Then there is the other section, the other act, that is IBC, which again reiterates that the valuation under IBC has to be done from a registered valuer. And under SEBI, in the few cases of SEBI, the valuation has to be done by a registered valuer. So as of today, there are three situations where valuation has to be obtained from a registered valuer. Going forward, things may change, expected to change, and I'm sure within next 1 year, all laws will be integrated and there will be reference to only one valuer, registered valuer, whether it's FEMA, income tax, or property act, or whatever. All valuation has to be done from the taken from the registered valuer. So IBC, everybody has studied the IBC law under valuation or otherwise than valuation. Yeah. Any IP out here? No insolvency professional. Okay, so there is no insolvency professional out here also. Good. So valuation under IBC, because it will be a topic which will be covered in due course in your valuation course only. I'll just brief upon the valuation part for the IBC. Under IBC, as per the law, the RP, that is the resolution professional under the law, has to appoint 2 registered valuers. Exam question. How many valuers will be appointed? The answer is 2. Answer is 2. To determine what? Exam question. Determine liquidation value and fair value. Remember exam question. 2 values, liquidation value and exam fair value. Third exam question, when, on which date they have to calculate this liquidation value, fair value? The exam answer is at the insolvency commencement date. On the insolvency commencement date. So 3 questions. 2 registered valuers, fair value, liquidation value on the insolvency commencement date. Now, they have given that the fair value has to be determined as per the international valuation standard after physical verification of the inventory and the fixed assets of the corporate debtor. Right? So that is given. Now, if there is a deviation between the 2 registered valuers report, let's say the deviation is more than 10%, though it is not standardized, I'm just giving an example, then the RP can appoint the 3rd valuer. Exam question. When can an RP appoint a 3rd valuer? When there is a significant difference between the valuation of the 2 registered valuers. The 4th point, then in that case, what is the valuation which has to be taken? So in that case, the valuation will be the average of the 2 closest value estimates. The average of the 2 closest value estimates is considered as final. So remember, friends, yes, there could be the possibility of 3rd valuer being appointed. Now, what does fair value means? In general, when I say fair value, that is the value derived by the income approach. That is the normal concept, fair value as per the income approach. But here the fair value has been defined as per the IBC. It means the fair value is the estimated realizable value of the assets of the corporate debtor. Estimated realizable value of the assets of the corporate debtor, friends. Very important. If they were to be exchanged on the insolvency commencement date between a willing buyer and a willing seller in an arm's length transaction, and where after proper marketing and where the parties had acted upon without any compulsion. So that is a normal concept of determining a fair value. Along with that, the fair value. So again, exam question, estimated realizable value. Remember, estimated realizable value is the answer. Liquidation value, again, the answer is same, estimated realizable value, but the question is that it cannot be between a willing buyer and a willing seller. So here the situation might be different, where there is a willing seller and there might not be a willing buyer. So the only difference lies in the state, the condition. Otherwise, the assets will remain same, and what we have to estimate is a realizable value of the assets of the corporate debtor, friends. Another exam question. So there are so many exam questions which are coming up. Another exam question. The valuation will be done of the assets. The valuation will be done of the assets of the corporate debtor. No liability will be valued. Remember, no liability will be valued. No liability will be valued. Only assets are valued under IBC. Very important, friends. Now, there are a lot of issues, friends, for valuation under IBC. And if we start discussing on the same, I'll take another 1 hour for discussion on the valuation aspect of IBC. So being an insolvency professional myself and being a registered valuer, so after doing so many valuations and doing some insolvency assignment. Very tough job. I think tough job on both on the insolvency part as well as the valuation part. Why? Because it has got a lot of challenges, and because the law was new, so a lot of trial and error was there, and not much of a process was standardized, and therefore we have a lot of issues, and there are a lot of challenges in the valuation front also. Why? Because there is significant uncertainty because of the next step to be taken for the company, whether there is a possibility of a resolution plan or the company would go under liquidation. Now, how much time will it take for the plan to be accepted or liquidation to be done? So a lot of uncertainty regarding the future steps. Then absence of reliable data. That is a big challenge in this valuation world of IBC insolvency cases, because we don't get enough data. We have to rely on the RP for getting the data, and the RP in turn relies on the suspended management. So there's a change, and we all understand the suspended management may at times may not provide all kind of information which may be required for valuation part. So therefore, there would be absence of reliable data. Comparable situation may not be there because the company is a standalone company which has gone under stress, and you may not find some comparable firms also. And then we have to work within a strict timeline of, we all know that under IBC, the resolution has to be done within 180 days, further extended by 90 days. So there are strict timelines where we have to complete the whole valuation process. So these are the valuation challenges. Coming to very specific challenges, friends, I'll focus on one or two angles. That is, the first angle is the physical verification. Just to highlight, the major challenges that an valuer could face when valuing the company under IBC is the physical verification part. Now, again, just to take a test on whether you are attentive or not, can you tell me the valuation will be done on which date? Can anybody mention that date? Valuation will be done on which date? Yes, Mr. Rajesh, I think Mr. Subbu has mentioned is correctly. It's on the insolvency commencement date, not the liquidation date, but insolvency commencement date. No, not on the date of admitting. Yeah, admitting by the court, correct. Or date admitting on the court, because that date when the NCLT admits the case under IBC, that is the insolvency commencement date, friends. So remember, now, let's say, for example, the insolvency commencement date is today, 23rd August. So the moment the insolvency starts, the valuation will happen. The answer is no, because there's a process defined. And the valuer, as per law, will be appointed in 47 days. The valuer, as per law, will be appointed in 47 days. So that means the valuer will come for valuation if everything is normal. Maybe after 60 days. So the valuer may come under, let's say, in October, but the valuation has to be done for today. That is 23rd August. So that means valuer has to do certain back calculation trends to arrive at the correct figure of 23rd August in terms of physical movement as well as in the price part, if required. So that is a very big challenge where you have to do a back calculation. And if the company is running and has got a lot of stock, then we have additional work, right? So that's a major challenge in terms of physical verification. Then another challenge which comes in is if the assets constitute the technical items, who would do the valuation? Whether is it the SFA valuer who will do the valuation, or is it the plant and machinery? So still the dilemma is there, and a lot of thoughts have come in that who should do the valuation of the inventory part. So as in law, there's not much of clarity, And today the current scenario is that the valuation of inventory in a lot of cases are taken care by the plant and machinery, and in few cases it is done by the SFA valuer also. So it depends upon company to company. We cannot standardize. Okay. There could be some other challenges, friends, in terms of valuation for insolvency cases. But as I said, it requires a lot of discussion. Let's say valuation of investments done by the corporate debtor who is under insolvency. So if the company shows in the balance sheet that they have made investment in some other private limited companies, then how do you value such private limited companies which are totally out of the purview of the registered valuer, and then he does not have access to the current state of affairs of that particular company? So how should I value a private limited company which is being shown as an investment in the company which is under stress or under IBC? So again, that is one of the major challenges, friends. So a lot of challenges under the IBC valuation. In exam, can a practical question come? The answer is no. Not a possibility that we may expect a particular exam practical question. But yes, theoretically, we had discussed some of the points which will be sufficient to cover the theoretical part. Though we'll solve one practical question also, a practical question on the insolvency part. So let me open one question.
अच्छा आप शांति रख लो अपना नहा धो लो
I would request everybody to read this question. Rajesh, yes, there are not very complicated ways, very simple approach. You can do the valuation. You can just ping me separately. I can discuss it. Yeah, so please take a screenshot of this particular question so that we are able to answer the question properly when we solve it on Excel. Okay, so should I open up the Excel part and solve it for you? I hope the data is there with you when we solve it on Excel. So we need to determine the fair value and liquidation value. Okay, so if you read the question, there are certain information which is given in terms of debtors, investment, advances, and so on. So reading the question that we need to estimate the realizable value of assets under fair value and liquidation value. Realizable value. Now that is an estimation which we have to do as a valuer. Realizable value. Now how do you estimate the realizable value of debtors? Obviously, you will review the ledger part. You will see the transactions in the ledger, debtors ledger. What are the transactions, whether they are current, old, more than 6 months, more than 3 years old, whether the movement is there or not, whether confirmation is there from the debtors or not, any last confirmation, any provision has been made, any dispute has been there in the debtors part. So a lot of things could be explored by virtue of getting the documentation from the RP part. No, you need to get the documents from the RP. Then only you will be able to estimate it. So here in this case, it is mentioned that there is a possibility of recovery of around 25% of 30 lakhs. 25% of 30 lakhs. So when we say 25% of 30 lakhs, so that is fair value 7.5. So I'm taking the fair value as 7.5. Now, what could be the possible liquidation value? So when the fair value estimated from the debtors is 7.5, for me, liquidation value from debtors would be 0. Maybe for you, it might be different. For me, it is 0. Why? Because I don't expect the valuer to, the debtors to pay any amount. Once the company is getting into liquidation, I don't expect the company to pay. So therefore, liquidation value is 0. You may take it at 7.5 or less than 7.5. That is your subjectivity based on the documents which has been submitted to you. So as per my experience, I assume that it will not be paid. Therefore, the amount is taken as 0. Can we take it in every case? The answer is no, friends, because you need to understand what is the nature of debtors, the books, the ledger, and everything. And the amount also is material. If the amount was 75 crores, I would not have taken as 0. I would have taken certainly some reasonable amount under liquidation value based on the documents submitted. But here, because the amount is low, and even the management in the sense the RP would not be interested in filing a case against that particular debtor, so I take it as 0. Investment 0, because all the investment is done in group companies, and when it is done in group companies, and that too they are private limited companies, and you don't expect those shares to be sold. You do not have a market for selling of the private limited company shares. There's no market in existence. So how do you expect that the investments will be sold? So I'm taking it as 0, and that is a very practical scenario, because even if the investment is done in a running company, do you find any market for those private limited company shares? Do you think that somebody would come and buy out those company shares? The answer would be very less likely, very less likely. So therefore, I have taken as 0. In terms of advances, it is mentioned in the question that advances to the extent of 2 lakhs is recoverable. Nothing beyond that. Again, in terms of liquidation value, I'll take it as 0, because I don't expect that the person who is confirmed to pay 2 lakhs would pay any amount when he gets the information that the company is under liquidation. So I don't expect that the debtors part or the advances to whom the money has been given will be repaying certain amount. For cash and bank, I think we can take it as same. Once we can get a confirmation from the RP that the same has been received.
Naveenji, I have just one query regarding this question.
Yeah, please.
In the top, it says the debtors is 150 lakhs, and then it is talking about debtors more than 6 months and 3 years. Aren't we supposed to read the fair value as if it is a going concern and a liquidation value as if it is to be liquidated?
Yes, we need to consider fair value as a going concern.
Why, in this question, if it is an exam question, I'm sure the answer is right or wrong, but it is a particular answer. But why are we completely ignoring the fact that the fair value does not include anything out of 150 in case of debt?
As the laws mentions that we have to estimate the realizable value. Now, obviously, out of that 150 lakhs, the information which has been provided, it is saying that only 25% of the 30 lakhs. For rest, the RP has not provided any information. And even some information is given that the debtors are old, more than 6 months old, and some are 3 years old, but the amount has not been specified. So assuming that the realizable value the RP has shared, for rest, because he has not got the confirmation or is not sure of the collection part, therefore he has not given or shared any kind of concrete data. So
Was
in
this
that
an
context,
exam question?
No, as I said, getting an exam question from this perspective would be very difficult. So I'm just trying to solve it based on the practical experience. And because all the registered valuer will get an opportunity for valuation under IBC, that is why I'm trying to solve it out. Is it okay, Rohit ji?
Yes, sir, please.
Okay. GST, GST is mentioned that there is an ITC lying in the books of the account, which can be offset against the output liability. So GST, I would take it as a fair value, the same value, but in liquidation value, I'll take it as 0. But for fair value, I'll take it because as per law, the ITC credit can be utilized only for output liability. And if the company is liquidated, then there'll be no output liability, friends. One lakh and income tax refund 25,000, which I'll take it in both the cases because we expect that the TDS will be refunded because the company is into losses and there's no outstanding demand as of today. So that will be refunded by the department, whether it is under fair value or under liquidation value. So this is the overall scenario, friends. I think this will give us the final figure of the fair value and the liquidation value. Yes, Nikat, there might be a possibility on GST payable on assets sold or stock sold. As I said, therefore the fair value has been taken. But in case of liquidation, I assume that because the assets may be sold, in that case, if there is any output liability, it may be utilized. So we need to check whether there is any output liability on the assets sold or not. So if that is there, there might be a possibility. So here is the fair value and the liquidation value, friends. This is how the practical way of solving or determining the fair value and liquidation value can be done. I've taken it advanced. Right? Okay. So that was valuation under IBC cases, friends. So now coming on to the point of valuation for startups, friends. Valuation for startups. See, under IBC, as I said, there are a lot of issues, friends. And I believe that IBC has opened up a lot of new opportunities, new challenges, and a lot of difficulty in execution. But yes, there could be a good law where there are a lot of new opportunities which have come up for all the IP professionals. And even for people who have not been IP, but I think a lot of opportunities have come up for the professionals part. And we can explore a lot of merger and acquisition, buying out companies which are there available for sale in the IBC world. So as chartered accountant, as company secretary, as consultants, we can obviously explore this particular opportunity where we will find small private limited companies available for sale, that too at very less value. So this is a big opportunity, and I think one should explore this possible profession in a different perspective rather than the perspective of only the IP part. I think we can play an important role in the non-IP areas, right? Because IP part is a bit challenging, and the non-IP part could be done along with the support of other people. So therefore, I would always suggest that insolvency professional could open up, could be explored in other ways also. it has opened up the option of stress funding also. Stress funding, because now we see a lot of consultants coming up for stress funding, and a lot of companies under stress. So therefore, it is again opening up that particular area also. So next discussion, the next point of discussion is startups, and time to stand up is to understand how to value these startups. So we'll take a short 5-minute break, if you all permit. 5-minute break, and after 5 minutes, we are going to restart with the session. Right? 5-minute break. Yes, so let us start. So friends, startup world, altogether a different world. And at times we wonder that how companies of such background with only 2, 3, 4 years of background, and that too with continuous losses, they are being valued at such high price. We always wonder that who does that valuation and what is the criteria of that valuation. When you hear the news that this company, which is just 2 year old, recently, I think a few days back, there was a company, White Hat Junior, which was bought out by Byju's at a price of 300 million. At times you wonder, we have been into this profession for last 15, 20 years and continuously making profit, at least showing profits to the tax department, but never such value has been assigned to us. But for a company just for 2 years old, 3 years old, such high value has been provided. And in spite of that, they are making losses. So what are the criteria of doing such valuation? But just on the other note, friends, I wonder whether you have heard of this company, ClearTax, which is into the same domain area where we as professionals, being chartered accountant, company secretary, or consultants, work in the area of income tax, GST, and ROC, and all filings. And we wonder why do I mention that the word the company ClearTax? Because it is in a similar kind of profession, friends, or the service. And few years back, about 2 years back, I think the ClearTax was valued at a price of 200 crore plus. So you wonder that how a ClearTax company, which is into same domain, could be valued at such high price, but it was done. Then understanding that what is the possible reasons of such high valuation, a lot of answers come in from different people, that because it is into technology, it is able to market, is able to reach to out people. But again, friends, did anyone stop you from doing all these kind of steps, or adopting technology, reaching out to people, moving out to other areas? I think nobody stopped you from doing this. Who has stopped you? Nobody. So the whole concept comes to the basic, underlying fact that, it was all about vision. It's more of the vision, the thought process, and the ability to take risks. That is why they are there, and that is why we are not being able to reach to that particular state. So, Shrishti badalni hai to drishti badalni padegi. That is what people say, and that's what we need to adapt. And change in the thought process, where we need to look at world in a different perspective, and the capability of taking risks. Okay, so that's another point of discussion. Let us move ahead and discuss on the concept of valuation for startups. The characteristics of the word startup, the companies are, they don't have much of records, no past record, less revenue, or even a lot of working losses, depending upon private money. Many don't have a fate of being a going concern. That's always a question mark. A lot of claims on the value part, because the founder may claim one value, the investor may claim another value, and there's a lot of claims on the value. And the investments made in the startups are very illiquid in nature, that we all understand, because of the characteristic. So with this background, what is the challenges in the valuation front? Let us understand that. So approach would be obviously DCF. That is the normal case which we have seen. But Prince, in the world of startup, a lot of innovations have been brought in. And even in the world of valuation for startup, a lot of innovations have been brought in. And today what we are going to discuss is about around 9 methods of valuation for startup. So it's not only about DCF approach. Out of 9, DCF is one of them, but there are other methods which have been used by the startup ecosystem for valuation of their companies. So we'll discuss all these 9 methods. Practically, can we follow those 9 methods? I would say yes, in the Indian context and looking to the standards, those standards have not recommended these 9 methods. Standards have always referred to the 3 approaches. But probably these 9 methods give you an estimation of what could be a roundabout value of these kind of startups. That is where it can be used. But when it comes to putting down on paper, I would always suggest to go through the valuation standards, and through the valuation standards, try to value the startup companies. But then from exam perspective, we have to study these 9 methods, which are very relevant. And in exams, questions are asked from these 9 methods also. So let me go through these 9 methods. But before that, let's understand the challenges under the valuation, especially in the DCF front. And once we know the challenges, then it will be easy for all of us to calculate the value under the DCF approach. So the challenges are simple, that because they don't have a past, all these startups don't have a past. So extrapolating the future is quite difficult. Estimating the cash flows, FCFE, FCFF, calculating those cash flows becomes quite difficult because we don't have any past trend. So it is all based on, the management representation, certain hypothetical situations, which makes things tough. Can anybody tell me, how do I find out that the company is a startup or not?
सर उसका स्टार्टअप में रजिस्ट्रेशन होना जरूरी है, जो अपनी गवर्नमेंट और एक डिपार्टमेंट है, नाम अभी मेरे पे याद नहीं है, वहां पर रजिस्ट्रेशन होना जरूरी है.
Yes, Mr. Rohit, you are perfect. You have to be registered with Startup India. That is the DIPP. That's a government organization. That's a website, DIPP, which issues this certificate. So you can very well verify whether these companies are registered as a startup or not. So that is where you can find out whether the company is a startup. Otherwise, in general, today what is happening, every youth coming out of the college and having any kind of business, they say that I have a startup. That is the practical thing which is happening. But I think we need to evaluate whether you are a startup or not. Otherwise, koi bhi aa jata bolta sir, startup hai. Now, startup has certain criteria, friends. So once we have that certificate, then we'll assume that you are a startup. And then when you are a startup, then we can follow these approaches. Then there is a possibility of following these approaches. Okay, so the first problem is that the company does not have an existing asset. The second is that the major of the cash flows will be coming from the growth asset. And then therefore the problem arises of assessing the value which could be derived from the growth assets. That is again the future hypothetical scenario. The third problem, estimating the discount rate. As we all know now, because in discounting rate, especially K, we need the beta, and beta is always based on past data, remember. Remember, from exam perspective, beta is always based on past data. And as these companies, the startups don't have any past records, even for their comparable peer companies, they don't have much of past records. Estimating beta is quite tough. Estimating beta is quite tough. So therefore, estimating beta is a challenge in the calculation of the discount rate. Then terminal value, friends, because we have not actually done a lot of valuation questions, but when you will do all the valuation questions, you will come to one conclusion that let's say if a value of a company is 100 crores, you will find that the 60% of the value is coming from terminal value, which is very natural because terminal value will take into consideration all the values till infinity. So obviously major portion has to come from that particular part. But in case of startups, in the initial years, there are losses, as somebody had mentioned it yesterday only. There are losses for 1, 2, 3, 4, 5 years. And the maximum value in a lot of cases, it is 100% of the value coming from the terminal value. So that is always, tough to digest that, how do you value a company which is where value is only derived from the terminal value. So these are the challenges in the startup fronts. Now let us focus on the specific 9 methods, and then we'll understand all the DCF method also for the valuation of startup. So 9 methods, out of these 9 methods, the first three methods, they are based on a certain concept, friends. And the concept says that you have to consider the startup as a box, as a special box. The startup has got a special box where there is some good idea stored in this box. And somebody has invested some time and built up a particular product or a service or a technology which is inside this box, So that is why this box has got certain value. Agreed, because you have spent some time, you have made an effort to develop a particular service, technology, IP, thought process, but nothing on paper. Remember, a startup box does not mean it is everything on paper. It has to be in certain kind of concrete, tangible form. So it is like a box. Now, when you have put in certain time and effort, obviously this box will have certain value, that we agree. Now, let's say we assign a value of, let's say, 1 rupee. Now, how the value of the box will increase? So from the founder's perspective, if I want to increase the value of this box, so I can keep on putting in the effort, creating more products, more technology. That is one way. Or what we can do, we can patent my product. So the value of the box will increase naturally. Then what I can do is I add good people in my team. So let's say I'm working individually today, I will add one more partner. So the value of the box will increase. What I can do is then further, I can do a commercial launch, beta version launch of my product. That is a testing phase of my product. Then the value of the box will increase. If the beta product is successful, then I can plan for a commercial launch of my product. It may, the value of the box increase. I will do a commercial launch within my city. Next would be my state. Next would be my country. Then it would be international. So at every stage, the value of the box will keep on increasing. And at each particular stage, I keep on adding money. Somebody would keep on coming to my team, giving in money, pouring in money as an investor, the value would increase. So friends, here, the whole concept is that if you are adding value to this particular box, the value of the box should keep on increasing. And the value addition could be in different structure, formats, criteria, parameters, and subject to whether these parameters really add value or not, because there might be competition, there might be certain risk, and we have to incorporate it, take into consideration all those factors and understand whether this value is being actually added to this box or not. So very simple concept, which everybody can understand. I think even a non-financial person can also understand, yes, that my value of the box would be this amount because I've added A, B, C, D things in this particular box. So that is how the valuation of startup starts. the concept of valuation from the founder's perspective start. So based on this, let us understand the valuation methods. Two words from exam perspective. Two words from exam perspective. Remember, in the world of valuation, when the valuation, where you will get into the world of valuation ecosystem, you will find that they will use more commonly the two words pre-money valuation and post-money valuation. Pre-money valuation and post-money valuation. Remember, now what is a pre-money valuation? The value of the investment, the value of the box at the moment of investment. The value of the box at the moment of investment. That is a pre-money valuation. And post-money valuation, the post-money valuation is the value of the box after the investment is done. Value of the box after the investment is done. That is the post-money valuation. So remember, the relationship between pre-money and the post-money, the relationship between pre-money and post-money. Yes, relationship between pre-money and post-money would be post-money is equal to pre-money plus the amount of investment. Post-money is equal to pre-money plus the amount of investment. Right? So that is the relationship between pre-money and the post-money. So 9 methods listed on the screen, friends, starting from the first known as Burkus. Then we have the risk factor summation, the scorecard, comparable transactions, and so on. So let me start with the first one, and obviously we'll cover all the 9 methods. The first one says the Burkus method. Again, I'll highlight on the important features only, important features which are relevant from exam perspective, which are very much relevant from exam perspective. The first is that through Burkus method, we can value the box up to a maximum value of $2 million, up to a maximum value of $2 million. Remember, we can value the company up to a maximum value of $2 million, right? Why? Because it says that the value of the box is dependent upon 5 factors. The value of the box is dependent upon 5 factors. And what is that 5 factors? The 5 factors are sound idea, prototype, management team, and so on. And it tells that they will assign a maximum value of 4 lakhs to each of the 5 factors. Assign 4 lakhs to each of the 5 factors. So 5 factors, 4 lakh multiply karenge, so we'll get the answer as 2 million. That is why the maximum value which can be assigned is what? The 2 million, friends. Remember, 2 million is the maximum value which can be assigned. Okay, now because it is 5 factors and 2 million is the maximum value, therefore it is not used widely. But yes, it gives you an idea that how to value my startup. So here, let's say in our example, on various criteria, we have assigned a particular value to this particular startup, and we give 3 marks of 3 lakhs out of 4 lakhs because of idea, 1 lakh out of 4 lakh because of technology, and so on. And when we add all the criteria, we get a total value of 10 lakhs. We get the total value of 10 lakhs. So the value of the startup is 10 lakhs. Now, is this beneficial? The answer is yes, because from the founder's perspective, I get to know that where am I lacking? Because these are individual subject-wise score. So I know that my marks are less because of this particular subject. So I can work upon that subject and improve my valuation part. So very basic thing, very crude form of valuation for any kind of startup. Nikhar, I think that is the most tough part, that if the comparable company is not available, and that is why I said if you want to use it in Indian context, probably the answer would be no, because the Indian market is not so matured enough in the current sense in terms of startup and technology, and therefore all these methods have been used widely in the US and the foreign markets where the market is matured enough, and probably because you can find certain kind of similar company, not if comparable, but similar company which is in the same domain or same industry. Therefore, from there we can pick up and do a comparison. But if that is not available, then it's quite tough to adopt all these kind of methods. Okay, the second method is risk factor summation method. Risk factor summation method, which is Again, same thing, which is same as Burkus. So instead of 5, we have 12. Instead of 5, we have 12 factors to be taken into consideration. So remember, risk factor 12 factors to be taken. And how do we calculate? So here we start again with the initial concept of that I assign an initial value to the box, right? So initial value to the box will be assigned based on the comparable firm which is there within the same region and the same domain, and based on that we start with a valuation of 15 lakhs, and then out of these 12 factors we keep on adding or deducting. So adding and deducting is based on multiples of 2,50,000. Adding and deducting is based on multiples of 2,50,000, friends. So let's say in the screen, if you see management risk, which is low, therefore I have added 5 lakh. That is twice the amount of 2,50,000. So my value of the box the comparable firms are normal. Therefore, I'm not doing any addition and deletion. And in terms of competition risk, there is high. Therefore, I've deducted 5 lakhs. So in all together, when I add and less, I arrive at a box valuation of 2750. I arrive at a box valuation of 2750, friends. So that is how you arrive at a particular value of the box based on risk factor summation. So we assign 12 risk, we add, summation is what, add or less, and then the final figure. So a further extension of Burkus has 5, here we have 12 factors. Then we have the third, scorecard valuation method, friends. Now scorecard valuation method is again further extension to the Burkus and the risk factor summation method. But I think more mathematically correct, because here we are assigning weights. We are assigning weights to each of the factors, and obviously because each industry factor would be different, and therefore the weights would be an appropriate way of assigning value. So let's say in our example, we start with the initial value of the box as 15 lakhs, and then we assign that weights based on the industry. That team capacity will be given as weight of 40%, then technology, market size, and competition, and so on. And then we do a comparison of my company with the market companies, the available comparable firms. And I find that my performance, my company rates about, in terms of team capacity, 125% above the average project. So how much value should I assign because of the team capacity based on weights? Can anybody do a calculation? 40% to 125%? 40% into 125%? Anybody? Yeah, 50. Okay. Then 30% into 100. 30% into 130. Then last small correction, 20% into 150. 20% into 150. 30 again, and last 75% into 10%. So 7.5. So when we add everything, so total comes to 117.5. Total comes to 117.5. Now, what is this 117.5? This is a multiple which we can assign. This is a multiple which we can assign to this particular box. So initial value is 15 lakhs, multiplying it with 117.5 will give me the box valuation of 17,60,250. 17,60,250, friends. So that is how the valuation is done. Friends. So very good, very good method where we have to apply weights, which is very general and very common and very logical also. So these are the first 3 methods of startup valuation, friends. Then we come to the comparable transaction method. I think yesterday we had discussed the relative valuation, friends, very important. And we had understood, we have solved some, we have seen some practical scenarios also. So even in the case of startups, the comparable transaction method is used. And let me tell you, friends, I think worldwide, I think it is the most widely followed method for valuation of startups, where the value of any startup is based on some comparable transaction which has just happened in the last 6 months, 1 year or so. And that is why people are keeping a track of all the transactions which are happening, and they're devising new ways of comparison. Yesterday we had understood that the comparison could be done based on enterprise value upon sales, enterprise value upon EBITDA, price to P ratio. So these were the criteria of determining the value for price to book value. Today what we'll understand is, apart from all these criteria, these could be the possible criteria, but we know in case of startups, P ratio won't work. In case of startups, a lot of there's no EBITDA, there's no profitability. So how can we take EV upon EBITDA margin? So book value, because all these startups work more on the intangible concept, so there is no book value. So there could be only one way, that is enterprise value upon sales. But apart from that, are there any other ways? The answer is yes, friends. There could be possible other number of ways for doing a comparison. Now, what are the other ways? So it could be based on number of HR headcount, the BPO industry, based on the headcount, number of patents filed, number of weekly active users, the gross merchandise value, where the Flipkart and the Amazons are based on the valuation of gross merchandise value, the value of goods they are able to sell, so GMV. Then there could be number of downloads, the apps, the companies which are based on apps, the number of downloads, the Dream 11 companies which are basically running all those online games on cricket and everything. These Dream 11 companies are based on number of active users. Number of active users. So all these startup companies are based on some other concepts. It may not be always the same kind of parameter which could be used for valuation of all these startups. Each startup has got a different specific criteria, and we can develop new ways of identifying the criteria of valuing a particular startup. All these artificial intelligence companies, the robotics companies, the IoT, Internet of Things companies, they will be based on some other criteria, because artificial intelligence will be based on the number of times you use that artificial intelligence software. So that could be the possible ways, the number of clicks which you do on that particular chatbots. So, the comparable transactions could be developed, and it is still developing. So my sales divided by this could be the possible comparable transaction. So the world of Ubers, the world of Yatras, the world of the Baijus, the world of Dream 11 companies, all these are developed based on, modeled or valued based on comparable transaction methods. And most widely followed. For this, you need to do a lot of market research, a lot of data crunching, and you need to keep a track of all those transactions which are happening around you and develop a worksheet. And then you need to map your target company with these transactions which have happened. And once you map it with these companies, probably then you will be able to value a target company based on the comparable transaction method. So it involves a lot of data crunching, which is not available in India so easily. That's the biggest problem. So quite tough if you want to follow it in Indian context. But yes, internationally, you will get a lot of data available in the public domain. That is why comparable transaction method could be used. The next, book value, not suggestible and not followed, because startup as such don't have any book value, because we don't have much of tangible assets here. So therefore, it is not followed. So book value not to be preferred. Then liquidation value against the principles of going concern. So again, not suggestible. Yes. So against the principles of going concern, therefore again not followed. So liquidation value, again, because there are not much of assets also, you don't have that much of liquidation value. Then we have the DCF approach, which we have discussed, that what are the possible issues. Practically speaking, that when you want to value a startup, I think in most of the cases which I have done as a valuation of a startup, I have adopted a DCF approach only. In one cases, I have adopted the scorecard valuation method also. But in most of the cases, it is the DCF approach only which we have used for valuation of the startup friends, and most widely accepted. Again, the biggest challenge is estimating the cash flows, which are again based on very hypothetical scenarios, which we have to understand at times, but very difficult call to find out whether these valuations with the forecasted cash flows are correct or not. Yes, I think very relevant, friends. The first Chicago method, very relevant. And practically what I see that looking after the COVID period, this could be the method which, which is very logical. I think everybody in the current scenario does it invariably, but they do it in mentally, but not putting on paper. Some might be doing it on paper, but I believe that this would be the trend in going forward. The first Chicago method, where what do they see? They see that there could be possible three scenarios for a particular company. It may not be related to startup. I'm talking in general. And the three scenarios could be the worst, best, and the normal case scenario, which normally happens with every people, individual, company, businesses. And it is not always the normal case scenario which will persist. See, when you do the valuation part, the management will always give you the best of the figures, and they will, if they want a high valuation, so they will always give the best case scenario, which we see that it is a very ideal condition situation. So the practical way of adopting valuation would be to estimate all the three scenarios, and based on the three scenarios, we can assign weights, probability of each scenario happening. And till now the current issue was what could be the worst case scenario. That was also always a difficult call. But today that what is the worst case scenario. The worst case scenario today is zero sales. That is the COVID period. That is the worst case scenario. The company may be a going concern, but there might be a possibility that we are not having any sales. That is a possibility today. And you have a probability also. You have now a precedent happening in front of you that yes, there is a possibility of worst case scenario where it could be possible zero sales. And in that zero sale, what is the possible outcome? So therefore, today estimation of all these three scenarios are possible. So we estimate the value under each of the scenario and multiply it with the chances of happening that scenario and get the final valuation, which is always a better choice, which is nothing but an average basically. And the last is the venture capital method. Yes, friends, venture capital method, again, one of the methods which are followed by the investor community, investing community. Remember, obviously, whenever we want to value, it has to be from the perspective of the person who is going to invest. But investors are also of different category, ranging from the promoter, the stakeholders, the retail investors, the venture capitalists, the private equity, the lenders. So here, what the investor community means is from the venture capitalists, the private equity people who are making a lot of investments in the world of startups. We read in newspapers that today the whole investment world is running after the startups, and that is why such high valuations have been given to these startups. So how do these venture capitalists, these private equity, value such kind of companies, friends? So see, what we have understood is the cash flows part, the present value cash flow part. That is fine. That is one angle of looking at the valuation part. But the other angle could be purely from the return perspective, that as an investor, I'm looking for the return. I am least concerned about how that return is achieved. But my main concern is today, if I'm putting 1 lakh, my 1 lakh should be 20 times in next 3 years, 5 years. So 1 lakh should get converted into 20 lakhs, or whatever is the value of the company today. After my investment, that value of the company should be 10 times after 5 years, 10 years, and so on. So that is how they look into the investment part. So a simple logical mathematical way, giving you an example on this slide, what we need to understand is the venture capital method. So where will they start? The first step the venture capital would like to estimate is whether there is any possibility of exit value, a sale value after the period of investment. So they will estimate that what could be the possible sale value after 5 years, 10 years, and so on. That is known as the exit value. Then only the investment will be done. If there is a possible exit value, then they think yes, investment could be done, because they are not interested in carrying on the investment till jab tak hai jahan tak, right? So they will not be interested in that part. So they'll be investing at a particular time frame. So let's say in our example, they estimate an anticipated exit value of 100 million. So they estimate that 100 million would be the possible exit value. Now, how do they estimate? That's a question, friend. How do they estimate the exit value? So the answer is by comparable transaction. So from a comparable transaction, they would find that after 5 years, the possible sales of the company could be this. And because the sales is this, the enterprise value could be this, based on a sales multiple factor, or could be the user factor, or any other factor. So from a comparable transaction, they would like to identify what is the possible anticipated exit value, which in purely financial terms means future value. Which in purely financial terms means future value. Now, because the investment is being done today and the worth of the company is determined today, so they will simply calculate the present value of that future value as of today. Based on, now how do we calculate the present value? We need to know the discount rate. So based on the discount rate or the return expectation of the venture capitalists. Venture capitalist return expectation, based on that return expectation, they will calculate the present value. So in our example, their return expectation is 20 times the increase in the value, 20 times the increase in the value from the current base. So if 100 million is the exit value and 20 times is the expected ROI, so the current value would be 5 million. Current value would be 5 million. Now remember, this 5 million is what value? Whenever we were talking world of startup, remember friends, two values: pre-money, post-money. Pre-money, post-money. Always remember this word. Put it into your permanent memory. Put it into your memory, your mobile screen as a screensaver. Pre-money, post-money. That post-money is after the investment is done. So this 5 million is the post-money. This 5 million is your post-money valuation. That means the investment has been done and the value of the startup is 5 million, which will increase by 20 times in next 5-10 years, which will give me an exit value of 100 million. Now, if post money is 5 million, what is my pre-money? So pre-money would be simple: 5 million minus the amount of investment. So here, let's say example is 1 million. So my pre-money is 4 million. So my pre-money is 4 million, friends. So pre-money valuation 4 million, post-money valuation 5 million, amount of investment is 1 million. So if you talk in terms of percentage, today I will invest, I will have a 20% stake in terms of post-money valuation, 1 million out of divided by 5 million. So that 20% stake would give me a total exit value of around 20 million in next 5 to 10 years. Because 100 million is the final value, my 20% stake is 20 million. So my 1 million will go to 20 million in next 5 years. So this is a very simple calculation done in terms of venture capitalists, purely in terms of what return perspective. So based on this, let us solve one question, friends. Again, just to give you an way that how the calculation can be done. Yeah, just got disconnected on the voice part. I hope the question is now taken as a screenshot. Let me solve it on Excel, friends. Okay. So where do we start? We'll put in the basic structure, friends. Again, using of Excel, as I said, is important, but very important how to use it structurally. That's important, friends. Everybody knows how to use Excel, but when it comes to exam, within a short frame of time, with a lot of pressures, you need to apply a structured way of solving it on Excel. So what is a structured way? Let us put some basic data. So investment, discount rate, period, founder shares, whatever data is given, let's put it down. Founder shares, sales after 5 years, sales multiple. So can I have the investment amount? Anybody who can give me the figure? What is the investment? Anybody who's taken a snapshot?
$22.50.
22.5 crores. Discount rate 45%. Period 6 years. Founder shares 12 lakhs. After 5 years, how much? Sales after 5 years?
525 lakhs.
52 crores, 50 lakhs. 52 crore, 52 lakh 50,000?
52 crores, yeah.
No, is it 52 crores or 52 lakhs?
52 crores.
And sales multiple 5. Yeah. Any other data? First step, exit value. This is the exit value after 6 years. Sales multiple 5 multiplied by the sales. Then second step, present value of the exit value. This is nothing but post money. So how do we calculate the present value? We discount the exit value. I will write down the formula on the right hand side. Now, what is pre-money? We know the formula for pre-money is post-money minus the amount of investment. Any confusion, please ask.
Sir, I have one question. So may I ask a question, please?
Yes, please.
This, you've written the exit value. Now, from the question that has been put up, how do we know exit value is the multiple of the sales for 5 years?
Sir, your question is valid because there is no other alternative way of finding out the exit value. Therefore, I have taken this particular because there is no other multiple which is given. So I assume that it will be on sales. If there was a specific information, I would have surely taken that. But with the limited information, I have just assumed that.
Okay.
Yeah. Okay, so we have calculated the exit value. We have calculated the pre-money. Anything till now? No. Okay. So let me go ahead. So the question had 4 parts. The question had 4 parts. Now the percentage holding of the investor. Now, how do I calculate the percentage holding of the investor, friend? So how do I calculate the percentage holding of the investor? Very simple, friend. If you have 10 lakh rupees invested in a company and the value of the company is 1 crore, the value of the company is 1 crore and you have invested 10 lakhs, what is your holding? Correct, Mr. Rohit, 10%. So same way here, my investment is 22 crore 50 lakhs. And the value of the company is 28 crores 24 lakhs, something like that. 0.79. So what is the percentage holding for the founder then? 1 minus this much? Yes. Any confusion till now? No? Okay. Now, number of shares to the investor. How many shares have been allotted to the investor? Can anybody give me a calculation part?
12 lakhs.
No, that was for the founder, Rohitji. Face value and premium to be checked, Rohitji. Rohit, I think we can do the mathematical calculation. See, percentage holding of the founder is 0.20, about 40 lakhs. Rajeshji, ekdam perfect hai. I'll give you the exact calculation. See, if the holding of the founder is 20%, so this 20% is reflected by this 12 lakhs. Can you see it on top? Highlighted in red. 20% is represented by 12 lakhs. Therefore, 79% would be represented by how many lakhs? How many number of shares? Right? So, very simple logical way. $47 lakh shares. 47 lakh shares. Then what is the price per share? So if the amount of investment is 22 crore 50 lakhs and the number of shares is 47 lakhs, correct? I've invested 22 crores. Against that, I've been allotted 47 lakh shares. So price per share is 47.86. These are the four questions of the four parts of the questions, and we have answered all the four parts. This is how the venture capitalist will look from the investor's perspective. Any doubts out here? No. Great. So this is all about valuation for startup, friends. Going back to my presentation again to cover up the rest of the matters. Valuation of cyclical firms. Valuation of cyclical firms. We all know what is a cyclical firm. Cyclical firm is a firm which will operate in cycles. That means it will have a peak period, it will have a non-peak period, it will have a peak period, it will have a non-peak period, it will go on continuously, and it will behave based on the cycle of the base commodity on which it is based, on which it is running the business. So they are subject to economic and commodity price cycle. They are subject to a lot of volatility in earnings and cash flows because the profits may fluctuate. Then when there is volatility in earnings, it may result in volatility in the equity values and the debt ratios also. A lot of biggest of the best of the firms have been subject to a lot of macro move. Yes, I'll give you an example. And normally these companies are characterized by finite resources. So all commodity-based industries are cyclical in nature, all commodity-based. Steel industry is a commodity-based, is a cyclical nature. All agro-based are sometimes commodity, are cyclical in nature. But if you see the current context, friends, I think all the big players, the big financial institutions, they have commoditized everything because there's so much of volatility in their market in all kind of products, except for the FMCG products and so on. But in all other products, there is so much of volatility. So wherever there is volatility and a lot of changes happening, I think this is because of the commoditization happening because of the big players coming into the market. But then one of the characteristics is that they are limited by finite resources. So if these are the characteristics, what is the issues in valuation, friends? The biggest challenge in the valuation of cyclical firms would be where to start the valuation from. So if you are doing the valuations today, can you start the base year as of today? The answer is no, because the current base year could be the peak year or the current base year could be the non-peak year. So from exam perspective, remember, one question would be asked on this particular topic is that what is that is required in valuation of the cyclical firms? The answer is normalization. We have to apply a normalization factor to the current base year if we are not taking the normal base year. So we need to have a normalization factor which will normalize the earnings based on the normal calculation, or we can find out the midpoint of the business cycle using statistical technique of mean, median, mode, average, and so on, and then apply that concept in the valuation of all these companies. So remember, one exam question in terms of valuation is the normalization factor. Identification of base year is very important, which will be based on the past economic data of the company and doing some calculation part on terms of statistical method. Otherwise, we'll apply the DCF approach. Yes, the next very important, friends, is the valuation of SME enterprises. That is small and medium enterprises, the private limited companies, which are in abundance in this country. and where we find that in times to come or in the current scenario, a lot of opportunities may creep up in terms of valuation issues, valuation assignments for the SME sector. Why am I saying that? Why am I saying that? Because if you see the what is happening around us, see, as a profession, I think as a professional, what we need to observe is not only what is happening within the profession, but what is happening in the economic concept, economic world, but also what is happening in the society. You have to take all these factors, then only you can increase your network and your work area. But if you are limited only to the professional area, I think you have a limited growth at times. So friends, why the valuation of SME would grow in times to come? Because as we have seen that the ecosystem is being. What kind of ecosystem am I talking about, friends? The ecosystem of Atmanirbharta, where the government is promoting entrepreneurship. Government is promoting entrepreneurship. There's an ecosystem of the startup where the government is supporting this ecosystem of startup, where they are promoting, giving incentives to the startup, giving schemes for the startup. So there are so many things happening in the world of startup, friends. So there's Atmanirbharta. There is the ecosystem of startup which has been developed, the funding aspect, the incentives aspect. So when these happen, probably everything starts with a small and medium. So going forward, I believe that the scope or the number of businesses coming under the SME segment will go up. And because of all the promotion done by the government that you have to register yourself as a Udyog Aadhar, MSME segment. And so many companies have registered within the particular SME segment. So one is the ecosystem has been developed. Good. The second angle is in the insolvency world, we will see that a lot of small private limited companies have now come under the insolvency phase, which were never available in the public domain for sale. Probably 2 years back, you would never find a private limited company available for sale in any part of this country because there was no market, no physical market, organized market available where I could find and search that if I want to purchase a company based in South India, a paper mill based in South India, was it a possibility? No, we could not reach to that particular company. But because these companies are now there available in the public domain under the insolvency, you'll find that all these private limited companies are available for sale, and therefore valuation opportunities will come in. Then the third thing which is happening, friends, is the demographic change. Again, very important factor which we need to again see and apprehend and then act accordingly. Is the current scenario of where the second generation people are not interested in carrying on their family businesses, where the second generation is more interested, the yo-yo, the high-due, the bro generation is now more interested in setting up their own new ways of doing business, new startup ideas, new crazy ventures, or they want to become a stand-up comedian, they want to become a celebrity, a YouTube follower, a social influencer. So all these second generation people are not interested in carrying on their family traditional business. So what is going to happen with all those family traditional businesses? If there is no succession plan happening, probably the best way would be to sell them out. And when the selling option comes in, the valuation opportunity will come in. So as a consultant today, it's a big opportunity when you need to identify the clients where you are not able to identify a succession plan for a particular business group. Then the ideal way to create value for all these companies would be to sell out these companies. And that is the business opportunity, friends. So valuation would be required under these scenario. And looking to this whole concept, I think there's always a BSE and NSE have come up with a lot of incentives for all small and medium enterprise to get listed on their stock exchange. And in last 10 years, you might have seen that a lot of companies have got listed, and maybe in future also the trend may continue, and you will see a lot of companies getting listed. And that in that case also we'll have a lot of valuation opportunities. So valuation of SME looks promising in terms of the number of companies coming up for the valuation part. Now, how do we value? That's the question. So the valuation method could be okay. So the valuation method could be the same, the DCF method, not a problem. So same approach could be followed for valuation of such companies. And we can obviously go for the comparable transaction. But as I said that in going for comparable transaction, we find a lot of issues in terms of market data. You don't get enough of the market data available so easily, except that whatever is available in the MCA part that we can get. But apart from that, we don't get so much of market data. Then because of lack of corporate governance in all these private limited companies, we understand that sometimes there is not much of disclosures in all these companies. And then the third factor, which is very important angle to be considered in all these private limited companies, is the dependency on a single person, which has to be incorporated in valuation. Because all these private limited companies are run by a single-handed person, and maybe the effect, how to do it, incorporate that effect, that has to be viewed. So valuation of SME, friends, very important, and these are the normal challenges and the method. Now, one very important thing which has to be considered in all these MSME private limited companies valuation is, is the concept of illiquidity or the lack of marketability. DLOM, that is one of the concepts which you have to understand. Discount for lack of marketability of the shares. So whenever you are valuing a private limited company, probably the discount rate may be something different because of the discount for the lack of marketability, which is always a concern because you will not be able to sell the shares so easily. So how do we calculate that discount of lack of marketability, friends? For that, again, if you want to study in detail, remember, friends, there are different materials which are available for you to study. Apart from the material provided by the RBO, you can always refer the valuation standards. Plus, along with the valuation standard, you can refer the technical guide issued by ICAI in 2018. It's a very comprehensive book on the valuation part. So in that technical guide on the valuation 2018 published by ICAI, you have got a lot of content and a lot of theoretical inputs along with the practical insights also, where every term is explained. And I believe that if you go through that, you will become an expert in the valuation field. So you can refer those to those material. And apart from that, as I said, please keep on solving practical questions, which are very much required. Use Excel, which are very much required. And you need to spend enough time before you appear in the exam. Once you are done with your course, I would request that please enroll for your exams in the first slot available near you. So maybe you should appear in the exams by maximum by 30th September. Don't delay your appearing the exam beyond 30th September because things are, all subject to Gajni Bimari. Gajni Bimari, humko sabko pata hai, if you are able to recall short-term memory loss. So if you delayed beyond 30th September, there might be loss of a lot of knowledge which you have gained in this valuation course. So to avoid that happening, I would suggest that please enroll before 30th September, appear in the exams and clear the exams in first or the second attempt. And when you appear in the exams, remember, friends, there are a lot of strategies which has to be developed for solving the questions during those 2 hours. Very critical that strategy has to be developed very thoughtfully. Once you have practiced a lot of questions, I think the strategies could be developed, friends. So I was talking about discount of lack of marketability. The way of incorporating discount of lack of marketability could be that, let's say if I calculate a discount rate of 20%, what I can do is to increase the discount rate by 4 to 5%. Normally, there is the normal trend which is generally available in the market, accepted by the market, that for discount of lack of marketability, we can add around 4 to 6%, depending upon the company's nature, to the existing discount rate, so that automatically the value will come down. Because when you increase the discount rate, the value will come down. So that is one way of incorporating the discount for lack of marketability, is by increasing the discounting rate. The other way could be let's say you have calculated a price of the company as 50 rupees per share, 50 rupees per share. So what you can do is give additional 20% discount for the lack of marketability. So the final price could be the 50 minus 20%, that is 40 rupees. So that is another way. Either we increase the discount rate or we deduct a certain percentage from the price which we have calculated. So these are the two ways where we can use the discount of lack of marketability factor, especially for small and private limited companies. Okay, coming to the last part of valuation of investment entities, friends, what is an investment entity? Is nothing but a holding company, where the holding company has made investment in many other private limited small companies. So the value of the investment companies will be equal to fair value of all the investments. Fair value of all the investment. Remember, from exam perspective, fair value of all the investment. So very important, friends, valuation of investment entities, that is holding companies, is nothing but valuation of all the fair value of the investment will give you the valuation of the investment companies. So this completes our whole discussion on the valuation of specific situation. Now let us solve some questions on the screen as multiple choice questions theoretically. And you can answer it on the chat box. You can answer it on the chat box, friends, right? So here we go with the multiple choice question. All the above? Okay, right. So this correct answer is all the above. Good. Next one. Yes, answer please. Yes, Rajesh, absolutely perfect. Healthy firms. No, Rohit, galat hai. It's a wrong answer. They are affected by economic price cycle. So the correct answer is C, where the healthy firms can also be put to risk if the macro environment is negative. Yes. Correct. None of the above. Yes. Yes, all of the above. Yes, correct. Everybody should get it correct.
Okay.
Yes, both A and B, correct. No, that is not the correct answer. The correct answer is technology, market, and product. All these methods do not incorporate the financial projection trends. Next. Yes, correct answer is 4. Correct, correct. Yeah, base period. Friends, remember in all these multiple choice questions, you have to understand the behavioral perspective, because all these questions which are framed under multiple choice, if you observe that all these are very, there is a very thin line on the difference between the answers. And if you understand the biological flow of selecting the correct answer, your eyes will always look for the answer which is there in your mind. Your eyes will always look for the answer which is there in your mind. That's a natural tendency. Now, your mind also works on a specific behavioral pattern, friends. It will always look at the answer, store an answer which on the concept which you have already studied. And normally in multiple choice question, whatever is there in your mind, it will be there in the answer. Whatever is there in your mind, it will be there in your answer. That will be a natural thing, remember. And your eyes will always get attracted to that particular answer. And in a natural course, you will select that particular answer, because your eyes, hand are working in conjunction with what is in your mind. But remember, whenever this happens, whenever this obvious things happens, please give a look the second time at the choice, at the question, that whether that question is in the current framework, in the correct framework of the answer which you are having in your mind or not. So do not always believe in the obvious. Do not always believe in the obvious. Remember that, because in MCQ, your obvious is the wrong answer. Your obvious is the wrong answer. Remember, right? So here, obviously, that is not the case. Base period is ignored. That is the correct answer. Yeah, anybody? The correct answer is beta. Market. The correct answer is fair value. Fair value. Fair value, friends. Friends, so this completes our total session on the valuation under specific situation. So I'll be sharing the PPT along with the answer sheet of Excel also, and I'll send it maybe today or by tomorrow on the WhatsApp group, so that you can review it for your preparation for the exam part. If you have any questions, you are always free to ask today, anytime on the WhatsApp group. Personally ping me so that I can answer to your question, friends. Right, friends? So we'll conclude this session here, and as I said, that please start preparing for the exam part, because the dates are coming very nearby. 30th September is the last date. So thank you, friends, and wish you all the best. Vijayji, I would request you to take over and Vijayji, आप हैं क्या? Vijayji, I think he'll join in. In the meantime, you can have 1 or 2 minutes of break, because the next faculty is again due at around 12:30. Or was it a break for all of you? Oh, good, Amit. Welcome. Good to see you out here. Appreciate it that you remember me.
Thank you, sir.
Good, good. आप अभी कहाँ पर based हैं?
सर रायगढ़ छत्तीसगढ़।
रायगढ़ से हो। Very good, very good, very good. Nice. चलिए आप अलग से कनेक्ट करते हैं प्राइवेटली ऑन दी व्हाट्सएप कभी भी, है ना?
Sure, sir.
Yeah. Okay, so let's wait for Vijayji. I think once he logs in, then I think the update will come in. So thank you and see you soon.